Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And after a shortened week last week, we are entering the markets here once again at all-time highs, at least when you measure it by looking at the S&P 500 and the Nasdaq 100, where we made a higher high in price. One thing to note is that momentum has not confirmed that higher high just yet. That doesn't mean it won't in the next few trading sessions, but so far we have not seen that confirmation, showing some level of exhaustion here on the equity markets pushing to new all-time highs. That is nothing new. We've seen a lot of that here over the last 6 months or so, but you certainly see it across both the Nasdaq 100 and the S&P 500, higher highs in price. So far not being confirmed by momentum. Note that the Nasdaq 100 is still continuing to outperform the S&P 500. Now, this is when you look at the market cap indices. When you look at the other indices, such as Russell 2000, the small cap indices, as you notice, the overall trend is not to the upside, but actually here to the downside, not able to make new relative highs, which actually means that you see a fairly significant amount of underperformance here from small caps relative to the mega cap indices over just the last couple of months or so. We're talking about, in this particular case, nearly 10% of underperformance here in under 2 months of time from small caps relative to large cap, the S&P 500. The other thing to also note is that the equal weight S&P 500 nowhere near all-time highs either, showing the participation in the S&P 500 rally is just not there. Also, as you can see, the equal weight index relative to the market cap index losing in this particular case, 6-7% in just the last couple of months due to this non-performance from the rest of the index. And this is something to really be considerate of when you're thinking about the equity markets. Is what's contributing to the gains, and it's really not there from the rest of the market. You just have a few names that's really dragging the markets higher here. If we look at growth versus value, we continue to see growth outperform value by a fairly significant margin here over the past couple of months. And this is something to be aware of here right now, because growth is really what's driving this market, or rather a few names within growth is driving this market. The rest of the market is not participating in this market rally. And that's something to be concerned about here. It's something we continue to see play out here. Commodities so far has responded poorly to this major resistance level here. We saw gold and oil perform quite well last week, but so far that performance has not contributed into this particular month. This is something to be aware of here right now as we currently look at commodities underperforming at the moment. If you look at bonds, we actually see bonds break out to new all-time highs, confirming a bit of a risk-on signal that we're continuing to see from bonds at the moment. So this is something that we're paying attention to here right now. The bond market's providing a bit of a risk-on signal here. And then you look at the VIX. The VIX, as you can see, is continuing to settle below that 13% level. The 50-day moving average, as you can see, continues to slope lower, and we continue to close below that 50-day moving average, really providing a bit of a risk on environment, but also at the same time a low volatility environment at the moment. Sorry, guys, excuse me. I apologize. So if we look at the 10-year yields, what you see here is the 10-year yields continue to moderate here. We're trading around that 4.3% level here on the 10-year yield. This is something that has continued to provide a bit of a tailwind for equities, and this is why we continue to see equities trade to new all-time highs, is on the back of lower than expected inflation print, which we're going to get again here on Thursday, the CPI print. That could continue to further provide kind of or keep the door open to potentially more than one rate cut for the rest of the year. And this is really what the optimism I would say that the equity markets continue to trade on, especially if you look at what's performing here. You know, if you look at the AI narrative, the growth names, the semiconductor names that are outperforming, it's really contributing to the outperformance of the S&P 500. A lot of that has to be due to the fact that rate cut expectations for the rest of this year continue to moderate, and we are trading at the lower end of the yield 10-year yield for 2024. So this is a chart that I would continue to monitor, see if we can see a breakdown here below 4.2% on yields on the back of the CPI print this Thursday, because that would very much provide kind of the continued tailwind that you need to see here for equities to push higher outside of earnings, which starts to kick off here this Friday with the major banks. You see TLT, the 10-year yield, long-term bonds continue to outperform here, breaking out above that 50-day moving average. So far, that $90 support level here on TLT so far has held. We really would like to see a breakout above 94 for bonds to continue. That would also correspond to 10-year yields breaking below 4.2% on the 10-year yield. So we're keeping a close eye here on bonds, because bonds so far providing a bit of that risk on signal here for equities. You do have the dollar index continuing to flirt around this 105 level, which is a major support and resistance level. At the end of last week, we broke below that level here. We've so far at the beginning of this week crossed back above this level. My hunch is that we'll likely see some weakness here from the dollar going forward, especially as yields stay around that 4.2% level. We have that inflation print here on Thursday. That is really what could potentially move the markets here on the dollar index. So we'll continue to monitor that. We do have Bitcoin breaking below the $60,000 level here. That certainly is potentially bearish here for Bitcoin going forward for those of you that do trade that asset. Gold continues to trade range bound between 2,300 and 2,450. It did rally up to that 2,400 level, looking like it was going to continue on to the top end of the range at 2,450, but so far it has kind of pulled back here. It's still staying above that 50-day moving average, so still constructive enough for this to potentially make another crack at 2,450. I think that is still potentially possible, and maybe forming that triple top here at 2,450. If we manage to break back above 2,450, that would be a very bullish signal here for gold. Yet to be seen here, but so far looking constructive here for a potential breakout, towards that 2,450 and potentially higher here. Oil, we did see oil pull back a little bit here, after breaking out above that $80 level, traded all the way up to 84. I do see that this could potentially pull back and correct a little bit back towards that $80 level, but likely we'll find some support around that 50-day moving average around $80, just because inventories right now still are on the lower end. We see demand, fairly decent here in terms of demand, and always the tensions in the Middle East with regards to the war in Israel. Certainly one of the factors to consider that is driving oil prices higher here over the past month and a half, after a bottom near that $72 level here. And then when we look at the overall sectors, we really continue to see only two sectors that are driving growth here, which is technology. As you can see, we made a higher high in price in terms of technology, but it did not make a higher high in terms of momentum. This is something to be aware of, meaning some level of exhaustion in the technology sector. even though it is one of the sectors that's leading the markets higher here. And we also see consumer discretionary. This was one of the sectors, one of the worst performing sectors in the NASDAQ 100 that we need to see play a bit of catch up in order to have more confidence in the market rally. And that's exactly what we've seen here over the past month. You really have seen consumer discretionary outperform the markets, and over the past few weeks, you've really started to see that outperformance relative to the S&P 500, making new highs and confirming those new highs on momentum. So consumer discretionary, really one of those sectors that we need to start paying attention to, especially as earnings season starts to kick off, seeing if consumer discretionary earnings can keep up with the performance that the equity markets are suggesting we might see from the consumer discretionary sector in the upcoming earnings season. Communications so far has, continued to grind higher here, but not outperforming. This is really a sector that largely has not outperformed or underperformed throughout all of 2024. It basically trades on par with the rest of the markets, and expectations for communications so far remains the same. You do have financials that report, this week you have JP Morgan, Wells Fargo, and Citigroup that report on Friday. So far, financials from a relative performance perspective is not particularly strong. Can we see financials play a bit of catch up here on earnings? That is certainly what a lot of bulls are looking for. We'll see if that happens here this week, at the end of this week and early next week, when most of the major banks will be reporting, and seeing if this can play a bit of catch up the same way consumer discretionary is. If it does, that certainly provides more confidence here to the equity rally. But if it doesn't, that would be an overall concern for me. Especially when you see consumer staples underperform the S&P 500. The healthcare sector underperforming the S&P 500, just made a new 52-week low relative to the S&P 500. And then you have materials and industrials also underperforming, making a new 52-week low in the last week. Materials, these are the types of sectors, industrials and materials. These are the type of sectors that should be performing in a equity markets that's printing new all-time highs. Yet, if you look at the relative performance of these sectors, they're actually making new 52-week lows. Those are some of the concerns. Can earnings play a bit of catch up in these particular sectors? That's what we're looking for. But if we don't get it, those are some of the overall concerns that we have with the health of the market rally. Real estate, very similar picture here. Made a new 52-week low relative to the S&P 500 in the last week or so. Energy, despite the strength here in oil prices, as you can see, energy shares rolling over at the 50-day moving average last week and continuing to tumble here this week. So energy shares not getting the boost that some investors may be hoping for, on the back of the fact that oil prices have gained nearly $10 in the last month and a half. Utilities also underperforming here over the past month or so, breaking below that 50-day moving average. Utilities, not giving that performance that a lot of investors might be looking for here at the moment. And then looking at some of the other sectors like home builders, as you can see, home builders broke down below a $100 support level. This was a major support level that we've been looking at here over the past couple of months. It finally broke below it. It's so far still holding below those levels. Will it continue moving lower? Looking at the relative performance of the S&P 500, it looks quite poor. We're talking about a sector that has lost nearly 15% of relative performance in the last 2 months. That's incredibly poor. And really a concern for me looking at home builders. And on the flip side, semiconductors, we saw a lot of strength here yesterday across the board for semis. Continuing to be incredibly strong here. We haven't made a new higher high in semiconductors here over the past couple of weeks, but we are within spitting distance of doing that here today. So keep an eye out here for semiconductors, as it has outperformed the S&P 500 in the last week or so. So despite the fact that semiconductors hasn't really outperformed much in the past month or so, we're starting to see some level of outperformance here over the past couple of weeks. And that might very well continue here over the next few trading sessions. So that kind of covers where we're looking at from a macro picture perspective, looking at the individual sectors. Let's take a look at some of the ideas for this week. The first one I want to take a look at here is Taiwan Semiconductors. Really one of the few semiconductors names that I think trades at a very reasonable valuation. The only concern I have with Taiwan Semiconductors is the fact that just yesterday we managed to break out above this double top, which is traditionally a bullish signal. But as you note, we have a double top with some lack of confirmation here from momentum. So you made a higher high in price, did not make a new higher high in terms of momentum. And that simply means that there's some level of exhaustion here to the upside that could lead to some short-term pullbacks here. But overall, if you look at the fundamental picture here for Taiwan Semiconductors, it looks quite attractive in my opinion. You have a stock that trades at 21 times forward earnings, which if you look at any of the semiconductor stocks, there are very few of them with the same outlook as Taiwan Semiconductors that's trading anywhere near 21 times forward earnings, which is pretty much on par with the average S&P 500 stock. But if you consider the fact that Taiwan Semiconductors is expecting to grow EPS and revenues by about 22-23%, you're talking about growth rates that are probably triple the average S&P 500 stock. So when you consider the fact that analysts are expecting the stock to grow 3 times faster than the S&P 500 stock, and it has and it has industry-leading margins. We're talking about net margins of 38%. So for every $1 in revenue they generate, they make 38 cents in net income. Something that we don't see very much from most companies. So the fact that they have very strong margins, very fast growth, yet it only trades at 21 times forward earnings. That's why I think Taiwan Semiconductors is one of the few rare opportunities in semiconductors at the moment. Another opportunity here that I see is Canadian Natural Resources. So recently it broke down below $37 as support. It came all the way back to retest that level as resistance. And I think this is the type of stock that can maybe trade back down to that $33 level here to the downside, which is a major support level here. And if you look at Canadian Natural Resources, it trades at 14 times forward earnings. But if you look at revenue growth, it's expected to decline by about 7-8%. It is still expected to grow EPS at a healthy 9%, but whenever a company revenue is meant to contract by 7-8%, that's never a good picture here, even with a natural resources company that has decent margins of 18%. 14 times forward earnings is on the higher end of its historical range and is a premium relative to its peers. So I think that, especially given the growth rates that we're expecting here for Canadian Natural Resources. So this is really where the technical picture, that rally all the way back up to 37, is a good opportunity to enter a short position here for Canadian Natural Resources. Next one I want to take a look at here is Garmin. If you look at Garmin here, it's been trading in this range between 160 and 165 for almost nearly 2 months now. It's been trading in a very tight range. And expectation is that I think this could potentially break below that 160 support level here. This is trading at 31 times forward earnings, which is a 50% premium relative to the average S&P 500 stock. So this is a stock that's trading at that's quite expensive here with regards to its valuation, especially given the fact that it's not expected to grow very fast. We're talking about 9-10% EPS and revenue growth, which is marginally higher than the average S&P 500 stock, yet it trades at a 50% premium. relative to the S&P 500 stock. It has decent margins of 25%, but that in itself is not enough, in my opinion, to justify Garmin trading at 31 times forward earnings. So this is really one where, as it trades in this trading range, the question is it a breakout higher? Does it break out lower here? I think when you look at the fundamentals, this is more likely to break down to the downside than it is to the upside. And then a couple of stocks that I think are just worth paying attention to here right now. Apple has had a really, really great run, let's call it that, since mid-April. This was a $165 stock. That's now a $227 stock on the back of, what is meaningful changes to its business with regards to its recent partnership with OpenAI in terms of integrating ChatGPT into the Mac OS system here. That certainly can boost usage of iPhone and their devices. But does that justify the current valuation it's trading at, which is about also 31 times forward earnings, a 50% premium relative to the average S&P 500 stock? Apple, just like Garmin, has good margins, 26% margins, but it's actually expected to grow even slower than Garmin. We're talking about 9% EPS growth, revenue growth of about 4%. So unless analysts have gotten this quite wrong with regards to how fast Apple will grow because of AI, the reality is that it's very expensive. We broke out above that 220 level here. It hasn't been confirmed by momentum here. So there's some level of exhaustion here. I think in the short run, there's a higher risk of this pulling back into the low 200s rather than this continuing to move higher here. So this is, in my opinion, probably less so of a bearish view, but just more of a warning signal of the excess that we're seeing from the mega cap names in technology and in consumer discretionary with names like Costco. You have a very similar price action here in terms of Costco, higher high in terms of price, but that has not been confirmed by higher highs in terms of momentum. It hasn't outperformed the S&P 500 on these new highs, and Costco, just like Apple, trades at very, very rich valuations, probably some of the richest valuations I've seen, 50 times forward earnings. Expected to grow, EPS by a healthy 11%, but revenue growth is only expected to come in around 6%. That does not justify a valuation 150% higher than the average S&P 500 stock, especially when you consider the fact that operating margins on Costco is about 3%. So for every $1 they make in revenue, they only earn about 3 cents in net income. Their model is obviously very different than your average retailing stock or supermarket stock, but the margins are not much better. So the fact that it trades at 50 times forward earnings is just a bit ridiculous. So if, a stock that was roughly $500 a few months ago, now trading at $880, worth taking a look at again as to whether or not these types of valuations make sense for you to continue investing in these types of names in your portfolio. And I'm bringing up Apple and Costco simply because I know it's in a lot of portfolios. So keep that in mind as you're thinking about these opportunities here in this market, and you think about these big names that are contributing to the S&P 500 and continue to make all-time highs. Doesn't make a lot of sense to you. That should help you inform your trading decisions as to whether you believe in this overall rally or you think that there is some risk to continuing to push higher in this equity rally. With that, hopefully this kind of helps you set up your overall week, gives you some ideas to trade for the week, and I'll see you guys here tomorrow for our next options education session, and I will see you guys here next week for our next Tuesday morning market outlook. Thank you so much and have a great trading day.